Hi, Richard. Thank you so much for accepting the interview today. Good to see you.
Good to see you.
Yeah, so the first question is about this week's biggest news, the Federal Reserve. So they have decided to keep the rates unchanged. However, at the same time, they revised the GDP growth forecast downward while raising the inflation and employment forecast projections. So do you see this as a shift, as an early sign of stagflation? And how should investors interpret these mixed signals?
It's a great question. First, let me turn to the SEP. For a long time, I've argued that these dots that come out of the SEP can be very misleading, particularly against the backdrop of something like a exogenous event, such as in this case, Trump tariffs or threat of tariffs. And so what do we have this time? We have a series of 19 dots from the 19 FOMC participants,
Yes.
right? And we don't know the foundation that those estimates were provided against. What were their assumptions, for example? When did they provide these estimates? A lot's been changing recently, so it's a big muddle. I don't put too much faith into the dots of the dot plot. However, putting those issues aside, I would say that the message of the Fed, at least with the dot plot and the policy statement that was issued up front on Wednesday, was as you say, a stagflation message. We saw growth bumped down, we saw inflation bumped up, and we saw unemployment bumped up. So I would say up front, it seemed to be quite a stagflation message. However, on the backside at the chairman's press conference, I would say again, in my judgment, Chair Powell tends to have some dovish inclination to him, and that inclination came out in his press conference. So the message up front was stagflation. On the back end, it was, don't worry, inflation's under control. We think expectations are okay. So it was a mixed bag. It was a mixed bag.
Yes, speaking about the divergence, we saw there's a sharp divergence in the Federal Reserve's policymakers' rate projections from the dot plot. So what does this internal division suggest about the Federal Reserve's confidence in its outlook? Also, how should investors interpret this kind of uncertainty and divergence among different policymakers?
Look, my opinion is we should all get away from this belief that economists are these hard scientists wearing white lab coats in the laboratory with precision of estimates. Economists are social scientists, and the best they can do is some general range of a projection. So I wouldn't get too jumpy either way about the movement in those dots, because even as particularly in an ever-changing environment, as Chair Powell said during his presser, he so much said it's very tough to predict in today's environment, and these predictions aren't worth that much. So I'll take him at his word for that. Don't put too much strength in the estimates of the SEPs.
So based on your projection, how many rate cuts will there be this year in 2025?
I think we're done.
For the year?
Yeah, as I may have said to you in
The beginning of this year.
at the end of this year, or at the end of last year, that I don't see the Fed cutting. Maybe once towards the end of the year, but I don't see it. I see inflationary pressures, independent of Trump's tariffs, as remaining high. I have the core PCE without consideration of an impact of tariffs at 2.8, still high. And I think the Fed needs to continue to focus on inflation and squeeze that out, because otherwise we're going to have long-term problems here.
In the presser, Powell also highlighted that consumer spending is moderating while household uncertainty is rising. So how much of a concern is this for economic growth? And will lower consumer spending, which accounts for 70% of the GDP growth in the United States, push the Federal Reserve to cut rates sooner than expected?
I think the consumer is slowing down.
Yeah.
They had massive savings from the fiscal and monetary policies that were presented to them as a result of COVID. And then after that, they drew those savings down, and then on the other side ran up credit card balances, right? And credit card balances are at record highs, although as a percent of income aren't concerning yet, but we're starting to see delinquencies tick up. Auto loan delinquencies are ticking up. So I think the consumer is coming close to being tapped out. That will be a drag on the U.S. economy. However, the key here at this point is that the Federal Reserve needs to focus on inflation first and foremost, and I think that may come at the expense of a drop in economic growth. I don't see us falling into a recession at this point, but it's not out of the question.
Why do you think right now inflation is the top priority for the Federal Reserve? Why couldn't it just be a little bit above 2%?
I think that the Federal Reserve appears a bit out of touch with the average person in society. True, the rate of price increases matter, but to most folks, it's the cumulative impact of inflation over many years. And Americans are hurting. The fact that inflation is just going up at a lower percent than it formerly was is nice, but that doesn't take away the big increases that occurred over the past several years. And so I think that we really need to squeeze out inflation and get it back to where we were. That's the rules. We can't change the rules of the game in the middle of the game, or the Federal Reserve is going to lose credibility.
Yeah, that's a very good point.
Yeah.
However, some analysts on the Wall Street right now are concerned because they think the Federal Reserve's monetary policy, restrictive monetary policy, may trigger liquidity concerns in the financial markets. Right now, did you observe any red flags in, like, for example, the banking sector or corporate debt markets that could lead to financial instability?
I think it's a fair concern to have on your radar screen. In fact, I believe that one reason the Fed slowed but did not eliminate their QT was just because of that. If they would have eliminated QT, that would be draining liquidity, and possibly that on the edge would turn into a problem, particularly against the backdrop of the congressional spending crisis. Once the debt limit is increased, the Treasury will look to backfill its account at the Fed, known as the TGA account, and by pulling funds out of the market to fill up their TGA account, if you will, that's going to drain some liquidity. So the Federal Reserve slowed its QT, in part, I think, keeping an eye on that concern that you ask about.
On the other hand, US President Donald Trump has again publicly pressured the Federal Reserve to cut interest rates, even though despite the central bank's historical independence. So how do you assess potential risks of political influence over monetary policy by central banks?
Yeah, I think, history is littered with examples of the downside of politicians getting in the way of central bank activities. In the U.S., we have the 70s with Richard Nixon and high inflation and so forth. Worldwide, there's many examples, Turkey, South America, and so forth. So I think, in general, it's accepted and understood that politicians have an inflationary bent to them. They would always prefer lower interest rates for their constituents, right? Mm-hmm. They vote for them. So, and that would not be the proper move in many cases. So I think we want to keep the Federal Reserve out of monetary policy decisions. The Congress out of monetary policy decisions of the Fed. Perfect example, as you mentioned, President Trump is jawboning Chair Powell to lower interest rates today. In my judgment, that would be terrible to lower interest rates today because inflation has plateaued, shows some evidence, even independent of the tariffs, of spiking up. And this is exactly what we don't want to do, is to cut interest rates. In fact, maybe part of the inflation problem today is due to the fact that the Federal Reserve cut interest rates, needing not to, in the fourth quarter of last year. Inflation had not tamed and the labor market remained strong, and they cut rates, as you recall. I don't think that was necessary, and I think that has bled somewhat into the stubborn inflation numbers that we're seeing today.
So, given your working experience inside of the Federal Reserve System over 20 years, what economic indicators will you be watching closely to assess if the economy is heading into maybe stagflation, recession, or even a crash?
I think most of the data that you and I look at, I mean, the Fed has
Inflation
access to
data?
all the data, and that but there's a couple risks out there that I think deserve mention. Importantly, banks. There's a lot of exposure to commercial real estate out there. Near $1 trillion of commercial real estate needs to get refinanced this year. And that's going to be tricky with commercial real estate values coming down. The loan to value ratios aren't going to work. If they do work and the loans are refinanced, they're going to be at higher interest rates. And this is going to cause a problem potentially for some banks. We're likely to see the so-called pretend and extend by banks, where they just lengthen out the maturity of the loans and so forth, but not all. So we're likely to see some headaches from the commercial real estate sector, in my judgment. The other issue, let's not forget about, a couple of years ago now, in 2023 in March, we had the old Silicon Valley Bank problem, SVB.
First Republic Bank, the
Right.
bank failure.
And you recall very well the problems that at least contributed to those failures, right? Or headaches. Treasury portfolios held by banks that lost their value. Normally, it's not a problem. If the value of Treasury portfolio goes down, it's an unrealized loss, unless you need to sell that portfolio to raise liquidity. And banks, if they get into a situation where they need to raise liquidity quickly, okay, they're out of reserves. They have to raise liquidity by selling those treasury bills or treasury securities. They're taking they will take a loss at that point, and that loss taps into their capital. So there's potential problems with banks there. Why might they want liquidity? I think because uninsured deposits will flee at the first sign of a problem. So this gets tricky. If we see a sharp economic downturn, if President Trump continues to be on again, off again with his tariffs, and the markets continue to get concerned about what's this mean for the economy, something like that could cause the flight of uninsured deposits, which in turn could cause some banks to liquidate their portfolios of treasury securities, take a loss, have to dip into their capital, and then we have another SVB type of a situation in the banking industry. So I think the Fed will keep a close eye on that, as well as the general indicators.